Hello, everybody, and welcome to this webinar on Solar Insurance 101. My name is Franny Flinteman. I'm project manager at Solarplaza and in charge of our Solar Asset Management North America Conference, which is happening on the 13th and 14th of April in San Diego. If you are interested in the event, in joining us in San Diego, please visit our website and have a look at our program and amazing speakers. For those of you who don't know Solarplaza yet, let me quickly introduce us to you. We are a global event organizer. We are based in Rotterdam, the Netherlands. We have hosted numerous events around the globe, and we have a network of over 60,000 PV professionals joining us at those events. We also have Solarplaza Consultancy. We are your partner for market entry data and project development opportunities. And we have a Solarplaza Foundation, which supports several solar projects around the world. So if you are interested in contributing to making impact together with us, please let us know and reach out to us. Before we get started, I have a few practical notes to share with you. You have the opportunity to submit questions to today's presenters by using the question box in your control panel on your screen. You can also use this panel and Q&A box to use if you encounter any technical issues. Our staff is here to support you with that. And this webinar is being recorded. We will send the recordings in the next few days. Our moderator of today is Jason Kaminsky. He is the CEO of KWH Analytics, and he helped grow the company into the leader in climate insurance, which it is today. So welcome, Jason. I'm also proud to tell you that KWH Analytics is the strategic partner of our Solar Asset Management Conference in San Diego in April. So once again, welcome, Jason. Happy to have you as the moderator of today. Let's not wait any longer. Let's start the show. And yeah, please, the floor is yours, Jason.
Great, thank you. Franny, can you hear me okay? Hear my audio check. Perfect. Well, good morning here from California and afternoon or evening, depending on your location. As Franny noted, I'm Jason Kaminsky. I'll be the moderator, but joined by a couple fantastic colleagues in the industry to talk about solar insurance. So the agenda today, Lindsay's going to go first. I'll introduce her in a moment. We'll do a poll, and then Jamie likewise, and we'll get into the presentation. So the way this is going to work, if you go forward one slide, is I'll introduce Lindsay, but in parallel, it's always helpful for me and us, I think, to set some baselines and learn from each other. So there is a poll. I think you just click the button. What is your role in insurance procurement, and are you actively involved in the risk management process? So while you're voting on that, you work directly with the brokers, provide info to the team, or you're just interested. I'm going to introduce Lindsay, and then we'll come back and we'll see the results. So Lindsay Cheng is a member of the Marsh Energy and Power Specialty Practice, a global commercial insurance brokerage team that delivers risk financing solutions to the largest energy companies in the world. As a client executive, Lindsay oversees and manages client service delivery, risk strategy, and program design. Prior to Marsh, she was the director of insurance for the North American business unit of Engie, a French-based multinational utility. Lindsay's based in Houston, Texas. Okay, so maybe we can pull up the results. All right, so some of you work directly, more than half are just interested, so this is good. It's a one-on-one. We'll create some foundational learnings for the group. Perfect. So we can go back to the slide, and we'll go over to Jamie. We'll sort of do the same process. So why don't we throw up the poll question, and I'll introduce Jamie in parallel. So maybe informed by the first question. On a scale of 1 to 5, what would you say your knowledge level is on renewable energy insurance? 1 being, I know nothing about it, and 5 being, I'm an expert and I should be giving the presentation. So I think about that. Jamie is the head of commercialization at SB Energy, a high-value renewable energy platform backed by SoftBank Group and Ares Climate Infrastructure. In this role, she sees, among other things, strategic insurance procurement. Prior to SB Energy, she was the head of operations for Cypress Creek Renewables and the director of global finance for SunEdison's YieldCo Terraform. She also served in the Obama administration, where she oversaw the Recovery Act portfolio, including helping to establish the loan program for then Secretary of Energy Stephen Chu. Fantastic. So why don't we look at the results? Okay, pretty even spread, I'd say, with a little bit of a bias towards less knowledge on the topic, which again is perfect for a 101. So thank you for that. Thank you for voting. We do have one more question. There's no more intros to do, so I'll just sort of narrate while we're doing it. We'll try to vote quickly so we can get into the presentation. But when do you consider insurance in your development process, to the extent you know, and to the extent you're a developer? So one is when we're choosing the location for a site. Second is when we're doing the design and equipment selection. Third is during the financing, and four is after it's built. And we'll talk a little bit on the webinar about how this has shifted over time, I think, to be a little bit earlier in the process. And I think we'll continue to do so. But why don't we look at the results, even if everyone hasn't had a chance to vote, and we'll get right into the presentation. Okay, so actually a third of you are doing it when you're choosing the location, and about half during the financing process. So great color. So with that, why don't we, I'll ask Lindsay to turn on her camera. And Lindsay's going to go first, and then I'm going to pop back on and go second, and Jamie's going to take us home. And there is Q&A, so if you put it in the box, we'll get to it at the end. So with that, hand over to you, Lindsay.
Hi, everyone. Can everyone hear me?
We can hear you.
Okay, perfect. So today we're going to talk about risk management 101. We're also going to talk a bit about the market and how to successfully market your insurance portfolio in the current conditions. First, with respect to risk management, you might be asking, what does that exactly mean? So risk management is analyzing the risk that's inherent to your portfolio. And there are a couple different ways to transfer risk once you've evaluated and analyzed what that actually is. Insurance is one risk transfer mechanism. Contractual risk transfer is also another way to lay off risk to counterparties, and is quite successful. And risk management maturity matters. It can make a difference within your organization. It can make a difference all the way from the individual project level to the portfolio level. It allows you to leverage risk, appropriately allocate it based on your company's individual risk appetite. Ultimately, it's beneficial to get to a place where you're not necessarily a victim of the current insurance market if it is in fact a hard market, which we'll talk about in just a second. So really having a risk management process in place, whether your organization has a formal risk manager or not, is key. And also, no matter the size of your organization, it can drive stability and it can drive synergies with respect to your individual projects and your portfolios. And it's going to ultimately help your organization survive the energy transition. It's going to help you thrive, and you'll be able to understand and manage those risks that exist. So next, we'll kind of talk about a little high level about what the market was doing as of Q4 2022. Property, which is generally for a solar project going to be the largest premium spend from an insurance risk transfer perspective, was up in the US about 11%. It was up plus 8% from Q3 22 to Q4 22. And this is pricing. So what's important to note here is that valuation and the property damage and business interruption values are going to affect pricing because it's rate times value. That's how you get to the premium. And valuations are trending upwards. That might be because it is more expensive for your company to rebuild in the event of a total loss, but it's also due to the pressures that the insurance market are that property insurers are putting on organizations to lift up values based on their perceptions of supply chain issues, which supply chain issues are prevalent, but there's ways to manage and communicate any valuation differences that exist with markets. And then casualty has stabilized a bit. It's up about 1%. Financial lines, your directors and officers, employment practices, fiduciary liability, that has actually decreased. A big driver of that is directors and officers. So there's been less de-SPAC activity in the market, which has driven rates down. And then cyber has increased 28%, but it was plus 48 in Q3 of 22. So I don't think cyber is necessarily a surprise to anyone. That is a market that I think will continue to evolve. Okay, and then this kind of gives a visual of the cyclical nature of the insurance market. So where we were in 2022, throughout 2022, there was increased competition, especially for insurance programs portfolios that were loss free, meaning, you know, if you're in a construction phase, you didn't have a historical builder's risk losses, you had a clean loss ratio, or if you've got a portfolio of operational assets, there were little to no losses on the portfolio. Rates were stabilizing and in some cases flat. Increases in 2022 were expected for those companies that did have loss activity, or there were expiring warranties. That would be key on the property side. And then moving into 2023, insurers are in the phase of de-risking their portfolio, so they are in some cases reducing capacity. That capacity is particularly impacted in critical cat areas. If you have a portfolio that's exposed to flood, wind, severe convective storm, earthquake, then cat capacity may be impacted. If you do have a portfolio that is not cat exposed and is loss free, then you might only be looking at single digit increases in rate. And then there's a huge focus on business interruption exposure, particularly for those assets that have a merchant component, because of the volatility with respect to business interruption and the fact that insurers have noticed via claims in the overall industry that the reporting of business interruption values was not necessarily accurate. And so in some cases, there were higher monthly caps. Business interruption is generally, there are caps on a monthly basis, so you would report your values for a given year, and then there's a cap, so that we're seeing those caps come down. And I do have a slide on that here in a bit. They're coming down because to mitigate that volatility in the event that there were a loss and the values were improperly reported on the business interruption worksheet. And then increases are expected for assets where there is loss history, and again, for expiring warranties. That really has not changed. So if you look here at this chart, the orange is where we are. So rates are rising strongly. It is a seller's market, but what is expected next is for their insurers to see that their profits are hefty, and then there's going to be more capital flowing into the market, in which case, you know, we start to turn in the cycle, rates will start to fall again, and it'll come full circle. So that is what we would expect in the future, and that's where we are in the orange with the arrow. All right, so to talk a little bit about supply chain, again, there have been some supply chain issues with various components, and that is causing delays, particularly builder's risk. If there is a loss, even in the operational phase, and you cannot get a critical component within a reasonable amount of time, that's affecting the payouts, and that's also affecting valuation and insurer's view. And a little bit on values as well. If insurers take the view that you are not truly evaluating your portfolio and digging into the values and really analyzing the true replacement cost for the assets that you're insuring, then they may apply an increase to your values based on what they view as the true increase to build. And so when you're reporting a replacement cost value, it's the cost to rebuild less any soft cost that you would not have to repeat. And if you feel, I would say, if you feel that your values shouldn't change because you're confident that it will not cost you, that the inflationary impacts have not affected your organization, then you can certainly communicate to that to your insurers, and your brokers can help you do that. But you need to have a reasonable story as to why you believe that, and you need to have data to back your position up, or you will be looking at potential increased pricing even if your rate does not increase due to the values. Next, we'll talk a little bit more about business interruption. So again, there's increased scrutiny. There's increased scrutiny for certainly merchant. Any projects that have a percentage that is merchant, that then there's additional scrutiny, not as much for PPA projects, but insurers are imposing monthly caps. We're seeing around 110% of the highest monthly declared value as the cap there. And for battery storage, it's critical that asset owners ensure accuracy of those time element values and provide a monthly breakdown. That's going to be critical to have in your submission to the markets for them to review. And then if there is a roadshow, some of you may participate in your organization's roadshow. It's definitely would be helpful to discuss how your business interruption values are determined and how internal stakeholders contribute to that within the organization. All right, so how do you mitigate the market other than having a strong, mature risk management program in place? How do you kind of execute on that beyond identifying risk, beyond determining your organization's risk appetite and how to transfer that risk? Well, you need to manage expectations, whether you're the individual, which most of you likely aren't, the ones responsible for the insurance program at your organization. It's still helpful to make sure that messaging is accurate and consistent with the reality of the marketplace and the reality of the individual situation, whether it be a portfolio that's clean or a portfolio that has significant losses. So knowledge is power. Also being realistic with respect to budget, so that there are not surprises and there are not impacts to individual projects. And then just staying in contact with brokers, making sure that you're getting the latest information with respect to concerns that insurers have and movement in the marketplace. Setting a clear strategy is also key. So knowing what is important to your insurers, what their positions are going to be, whether their capacity year over year is going to remain the same, or whether they're going to draw back capacity and you need to pivot with respect to the participants on your program. And then working in conjunction with the broker to develop a renewal strategy meeting that's actually supported by a very strategic process internally to ensure that key stakeholders like asset management, risk management, the CFO are all involved and understand the information that's going to the submission, approve of it, and know how that information may affect the outcome of your renewal. And the insurance business, insurers do appreciate face-to-face interaction, so that can also be helpful, especially in a market that is difficult. And then differentiating your risk profile. So how do you differ from others? How are you managing risk and mitigating potential loss to insurers, whether that be robust loss control program, your ESG profile, highlight that. Don't be afraid to say it, in whether it be in road shows or in calls with insurers, because that will help them understand that you're taking an active role in the management of risk. All right, and then a lot of these projects, financing is a key component, and lenders' insurance requirements are not always going to align with risk realities, and also will not always align with the realities of the marketplace. So what we see is sometimes application of sometimes excessive requirements, and management of insurance has often challenged the efficient and effective development of renewable energy assets. So projects can tend to be evaluated with the standard approach, not considering the individual risk profile of a project sponsor, and those differentiating factors that your company may have. And that has proven difficult. Also, one key thing here is portfolio-wide approach can diversify risk. So spreading risk across a portfolio can provide financial incentives, but sometimes there's been pushback with very conservative per project insurance requirements that are not particularly necessary. So it's all based on, you have to look at project finance at the project level, understanding how that fits into your broader organization, the individual risk profile of the project, and communicate that to lenders. So insurance requirements also can challenge companies' risk management strategy. So there's a wide variation of risk analysis and how analysis is deployed and employed. So when you're looking at a project, there may be modeling completed, and if modeling is completed in the wrong way, or if there's no data, if you're entering into a situation where you're coming upon a financing and there hasn't been any analysis done of the risk of a project, then carrying out or not carrying out sufficient analysis can undermine the ability of qualified project sponsors to optimize their risk appetite, right? So having the data, knowing your risk appetite, and effectively communicating that to financing counterparties is key. And then, also just back to the modeling, ensuring that the experience and expertise of individuals performing modeling is going to be key. Ensuring that you've got qualified engineers and actuaries involved in the process is going to make a difference, and is going to ensure that the data that you're presenting to counterparties is reliable. Thank you.
Great. Thank you, Lindsay, so much. Great introduction from Marsh and a broker's perspective. Let me see here if I have screen control yet. But I'm going to present a little bit just while we're getting the, I think I don't control my slides yet. My background, as Franny mentioned at the top, is I come from solar finance and structured finance. And what I came to appreciate is that, A, I didn't know a lot about insurance as a banker, and B, there's a lot of similarities, but also a lot of differences. And I entered really cold. I think a lot of us come from renewable energy and are trying to learn insurance. And I'm hoping to capture with my 10 or 15 minutes here just some of the fundamental concepts about how risk is assessed, maybe draw some comparisons about what I know as a solar individual and sort of what I learned about insurance along the way. Let me see here. Can I progress the slides forward yet? I think I can, but there's a lot. Okay, so a little bit about KWH Analytics. As Franny mentioned, we like to think of ourselves as a climate insurance company, and there's really a couple key products that we offer in the market today. So one is called the Solar Revenue Put. The nice thing about insurance and risk transfer is there's a lot of things under that umbrella that are able to be shifted into other markets. So one of those that we innovated is production risk. So the Solar Revenue Put is a multi-year production risk insurance product. And really, our clients buy it because it allows them to get better financing terms. So property, right, you have to buy because your lenders require it. Solar Revenue Put is something that you buy because you get a financial benefit for it. So that's something that we created, we distribute directly, and I compare that to property insurance, which is really what I'll spend most of the rest of the presentation on, and I think what Lindsay and Jamie cover as well, which is things like fire, flood, hurricane, earthquake, and I'll get into that a little bit more. And through that, we do work with brokers like Lindsay that really have a lot of experience working with clients and helping them figure out sort of the right way to position and tell their story. One of the interesting elements of insurance is that there's a value chain. So you have the client, so that's SP Energy. You have the broker, that's Marsh. You have a carrier. Sometimes with the carrier, you have someone called an agent, which is helping them underwrite. So that's what KWH is. So we're actually working on behalf of various insurance companies on the back end. And then if I keep going up the chain, there's actually reinsurance. So let me get to that now. If we want to understand renewable energy insurance, it's really critical to sort of put it in the global context. So renewable energy insurance, think of it as its own little P&L, its own little business unit. It sits within maybe an energy business unit, maybe an inland marine business unit, another kind of insurance, which then sits within a property business unit, which then sits in a carrier, right, an insurance company, so the one actually issuing the policy to you. And then there's something behind that called reinsurance. And reinsurance is basically insurance that insurance companies buy. And this is important because that typically renews 1/1, the January 1st renewal. And as Lindsay touched on, like if you read news on this was, I think they said, the hardest renewal, especially for natural catastrophes, in maybe 20 years. So anyone that's writing primary insurance for renewable energy or frankly anything, and they're buying their own reinsurance for it to say, if I have, a Hurricane Ian that really gives a big loss to me as an insurance company, I want to offload some of that to someone else. Those rates have just gone up quite dramatically. So that then filters back down through the value chain and makes everything more expensive. And that's where some of the stats that Lindsay showed earlier are coming from, right? Just property insurance generally, the rates have gone up. And renewable energy in parallel is like a newer asset class where people are still trying to figure it out. So that's sort of just maybe a little bit of the global context in which we sit. So perspective of an underwriter, the underwriters are the folks that the brokers interface with that ultimately come up with the coverage and the premium that they want to charge. And premium gets a lot of airtime, a lot of visibility, and I think appropriately so. But there's a few elements that underwriters are looking at to help assess what the premium should be. So the premium is how much you're going to pay for your policy. And as Lindsay noted, the coverage is typically for the replacement of the individual facility or group of facilities, solar project, as well as lost revenue. That's what the business interruption is, so lost revenue. Second is your deductible. So that's how much you have to pay as the owner before your insurance kicks in. So basically the first loss position. insurance companies like that because it aligns incentives, can sort of reduce some of this claims frequency sometimes if that there's sort of a burden on filing a claim and assessing the claim. So deductible is a key element there. Third is sublimit. So typically you're buying insurance for the full value of the project. And as Lindsay said, there might be a disagreement on what is the actual value of the project. So the full value of the project. But they might say for certain risks, and I'll talk about natural catastrophe, nat cat in a moment. For certain risks, we don't want to offer the full limit. So actually for a certain natural catastrophe, we're only going to give you a portion of the limit that you need. And that's really to manage, again, if you think about sort of the reinsurance raise their rates, so insurance are raising their rates. One of the things they're doing is managing their exposures, and sublimiting is a way to do that. And that sort of gets this other point which Lindsay touched on, which is the spread of risk. So if you're saying right now in solar, Texas hail, if you know anything about solar insurance, it's probably Texas hail is like a challenging market. One of the ways that carriers and underwriters look at it is I have a limited capacity for Texas hail, so I'm able to spread the risk of this particular client, not only from that single location, but to a variety of locations with a diversified risk profile, a diversified geographic profile. And that allows me to sort of justify, I guess, putting out exposure to Texas. And the last is terms and conditions. So this is things within the policy language itself about microcracks, about, typically for hail or hurricane, about how you're taking care of your vegetation on site, the things within the four corners of the policy that dictate when you can make a claim. So all of these are relevant. All of these are important. This is partly the role of broker helps to sort through is like, I have all these bids, basically. What does it mean for me as a client and what should I be asking for to the market? But you sort of need to be able to look at all of these in context in order to think through how is this going to be interpreted by an underwriter and how they're going to inform the quote that I'm going to get and how am I going to explain this to my bank. So nat cat gets a lot of attention, but I just wanted to spend a moment on comparing and contrasting the two primary kinds of risks. So one is called attritional risk, and that's sort of like the everyday risk, vandalism, inverter fire, some rodent in the combiner box. So that's attritional risk. That's been pretty stable. And then you have the nat cat, the natural catastrophe risk, and these are the really sort of lumpy, expensive risks. So if you look at the chart on the right, the blue is the average value of the nat cat. These are the sort of the shocks to the system that have caused the most concern to us as an industry, and I'd say to the carriers on the other end, about managing a renewable energy book of business. And frankly, what has been happening is if you think about the other side, as deductibles have gone up, sublimits have been introduced, more and more of this risk has been pushed onto the asset owner. I'm going to talk about that as well in a moment. So let's just talk about nat cat for 1 minute, because that gets a lot of attention. What was interesting to me is that my background is not insurance, my background is solar, is that really the two most sensitive perils, they call it, are hurricane and earthquake. So if you think about from a global insurance perspective, where there's the most exposure, it's historically been hurricane and earthquake. So there's a lot of discussion about like Florida hurricane coverage, just set aside solar, it's like very hard to get, very expensive. Then there's also these other perils, they sometimes actually call them secondary perils, which include fire, flood, and a very severe convective storm, which is hail, tornado, things like that, which are actually probably the primary concerns in solar. And why it's hard is that what you're trying to assess is both, Lindsay touched on models, what is the frequency of that event occurring or the magnitude of that event occurring, and then what's it going to do to your system? So what does that actually mean on the ground? And what we're seeing, maybe fortunately, is that there's been more innovation in our space around how to address the actual loss profile from these systems. And I think Lindsay was correct that there's still sort of a broad brush painted where KWH looks to differentiate is that we come from the industry. We can really more, with a refined view, assess the risk management on a site. But things like hailstow, things like vegetation management, really were not, I'd say, active topics of conversation 5 years ago. And now today at the upcoming Solar Asset Management Conference, I think there's 3 or 4 panels that are all focused on insurance because it's become a much bigger risk factor to the projects, as well as to the financing and the operation and everything else. So, if I look back at the last maybe 10, 15 years of insurance as it relates to renewable energy, I kind of think of it in 3 eras. So pre-2019, when I was in banking, insurance was easy to come by. I put in the loan docs. I didn't think about it. People showed up with almost as much insurance as I could ask for. And it was abundant. It was cheap. 2019 was a seminal event. The other thing, if you know about renewable energy insurance, would be like everyone's heard of Midway, big hail loss in Texas. And that was the first of, unfortunately, many. So 2019 to today, let's say, we've had a series of hail, fire, other sorts of losses that predominantly have been Nat Cat, led to some innovation, led to some additional resiliency out in the field. And I think going forward, resilience is key. So we're seeing more and more innovation, more and more knowledge, I think, on behalf of brokers and carriers about what can and should be done in the field. Jamie's going to talk a little bit about how to position a portfolio as an asset owner. But I think carriers have said, look, we're not going to just take 100% of the loss and not have any real incentive for the asset owners to be managing this risk proactively. And as a result, it's made, honestly, you've heard the phrase, it's a hard market. It's made it harder to get the adequate coverage. So as a buyer of insurance, I think it's really important to make sure your broker is really canvassing the market, ask for a marketing list. There's new entrants like KWH, like, are we on it? Have they showed it to the various markets? Are you getting the best deal you can for your coverage and for your portfolio? Because it's a very dynamic market, especially for renewable energy insurance. Incredibly dynamic. Certain carriers are coming in and out. How they're assessing risk is changing all the time. Policy forms are changing a lot more quickly than you would imagine for insurance. And, ultimately, there's a lot of stakeholders. There's the owner, there's the carrier, there's the bank, there's the bank's consultants, and getting alignment among all of those is critical to putting your deal together. And then you got to do it again the next year. So a very interesting topic, I think, and increasingly important topic to us as an industry. So that's mine. If you have any questions, we'll have time at the end again for questions. So thank you. Lindsay, do you want to pop on for a second? Maybe we can answer a question. I guess, Lindsay, I'll ask one question, which is, I sort of laid out the 3 eras of insurance pre-2019, maybe 2019 to today, and then today going forward. You also talked about the cycle of insurance. It's sort of insurance historically. There's hard markets and soft markets as capital flows in and out. I'm sort of elaborating on this question. One of the guys that works for me, he's written natural catastrophe businesses, so he's written non-renewable energy, but hurricane, earthquake, and he calls it the Nat Cat fundamentals. He's like, sublimits and deductibles are natural for any asset class that has natural catastrophe exposure to it. What's your view? Are we ever going to go back to sort of the pre-19 days, even in a softer market, or what should people expect if you had a crystal ball looking out 35, 10 years?
The market will remain cyclical, but I do agree with, with respect to Nat Cat. I mean, the reality is a lot of renewable energy assets are built in high Nat Cat areas. So there's inherent risk, and sublimits are a natural thing. I do think insurers' appetite is going to ebb and flow for those depending on the return on capital, right, of their book. So yeah, I mean, I think it's a part of it is cyclical, and a part is that appetite's going to fluctuate, but there's always going to be attention made to natural catastrophe exposure, and some of that's going to depend on those insurers that buy reinsurance, what the impacts of reinsurance on the capacity that they're willing to offer.
Yeah, I think that's right. It's I'd say don't shoot the messenger, but I sort of think maybe the days of pre-2019, a little loose underwriting, maybe I'll say that. And I do think as Nat Cat has become more serious, and frankly, as we've had losses as an industry, some of those structures are here to stay. Would be my view. And you know what that means, I think, is again, I'll bang on the resilience because the call is presumably mostly folks in asset management, like how you're operating these facilities, how you're constructing these facilities. I mean, location's important, right? If you build it in the middle of a hail zone in Texas, like naturally it's just going to be challenging. But your equipment selection, your operating procedures, your technology that you're deploying, they all have a factor in the loss profile. And I would say, honestly, one of the reasons I like collaborating with the Samna folks is this isn't an industry where like anyone benefits if your competitor has a huge loss. Like that probably hurts everyone. So the ability to share best practices, the ability to collaborate, and sort of say, hey, this is what we're seeing, I think is really important for us as an industry. We've been buying and selling insurance for decades, but I'd say really the focus on risk management as it relates to physical risk has really only gotten a spotlight shined on it in the last 3 or 4 years. So it's still a reasonably new topic for us as an industry would be the argument that I would make.
Yeah, and I would just to add to what you're saying. Bottom line is education's key, and like you said, if one peer in the industry has a significant loss, it's not a win for anyone. It's not a win for anyone.
Right.
So education, sharing knowledge is beneficial.
Okay, let me do a quick check. Jamie, are you able to hear us at all? Still not. Franny, I'm assuming maybe you're trying to email her or give her a buzz, but hopefully we're able to get her back because I know her slides are good, and I want her to be able to share those with everyone. Okay, so another question, are there weather derivative products which involve a payout in case of extreme weather without needing to justify or define a loss? I'm happy to take that one, Lindsay, unless, why don't you take it first and I'll hop on after you. Unless you want me to take it.
You can take it.
Okay, so there's a concept of, it's an emerging concept, I'd say, of something called parametric insurance. And parametric insurance means that most insurance, there's a loss, right? And then you file a claim and you say, I had a loss, and you quantify how much that loss is. Parametric insurance is triggered off of an index. Instead of having a physical asset with a loss, you'll say, think of agriculture, right? If there's 2 months without rain, my crops are going to die. So I'm just going to get a payout if there's 2 months without rain. Or if there's 5 days with frost in a row, my crops are going to die. So it's just sort of triggered off of a frost index. So they do have that. The ones in our space that are probably most relevant are Nat Cat related, so hurricane, sometimes cold wind, or hail. I think from what I've seen, there's been some but limited uptake. I know one of the things Jamie was going to talk about is getting sort of that whole value chain on board, the carrier, the client, as well as the bank. And banks like knowing that if there's a loss, they're going to get paid. And I think still in our space, it's like, okay, if there's 2-inch hail, is that going to cover me? If it's 3-inch hail, is that going to cover me? If it's 4-inch hail? So they do exist. It's called parametric insurance. There's providers of it out there. And I'd say from my perspective, it's emerging, certainly within our space. But Lindsay, I don't know if you have anything else on that you'd add or seen from your seat.
No, I think what I would add is I think lender appetite varies for parametric, but I think you covered all the bases there.
Okay, I'm going to ask this one to you, Lindsay, because you might have a better view. How are insurance companies, or I'll even say clients, thinking about cyber risk in the renewable energy market?
Yeah, so I think, going back to 2014, 2015, when I would sit, when I was, first of all, on the risk management side, and I would sit with peers, not many were focused on it, and certainly focused on transferring that risk via cyber insurance coverage. It wasn't as prevalent in the power and renewable space. That's not the case now. There's certainly a focus on cyber. There have been some large losses, and also there have been counterparty requirements, and risk managers should rightfully be concerned about, and asset managers concerned about evaluating that risk and whether it's best to transfer it. I'll stop there because I see Jamie now.
Great. Jamie, can you hear us?
I can. I feel like I've gone
through
many journeys to rejoin you here, but I am back.
Good. Well, we did our Q&A in the middle, so you have until the end if you need a time, and we'll go turn off. But I'm glad you were able to figure out the technical
I got to
issues.
hear everything. You just couldn't hear me. So.
Oh, good. Okay.
All right. Yeah. So let's jump into it. Thanks for covering. Lindsay and Jason, you did that seamlessly in a turbulent time. So I wanted to talk through, as Jason was discussing, kind of developers' perspective on this journey with insurance and Nat Cat. And I put Nat Cat in here because honestly, if you weren't in kind of an insurance and risk role, you really hadn't heard the phrase Nat Cat, which is a phrase we are using constantly now in our shop. But you wouldn't have heard it even 3 or 5 years ago. And so a big piece of that, right, is that, as Jason was sharing, we've just seen a huge amount of claims coming in, major claims into the insurance industry. I think it was something like between 2010 and 2019, there was 3 major claims, major meaning kind of over $50 million in the renewable energy industry. And we saw in 2021, I think someone just needs to go on mute. And in 2021, we saw 3 major claims in one weekend, right? So that's why this has become such a big journey. And honestly, this is one of the biggest things. There's projects that are being killed now in the solar industry. Jason, I think you just need to go on mute.
Oh, I'm sorry.
No worries. And so this is why, we're seeing projects actually being killed. Certainly in our shop, if we are seeing that we actually just can't make it pencil anymore from an insurance standpoint. So, just a delay. So who is SB Energy? So SB Energy is really a renewable energy platform that was launched by a bunch of industry vets. Most of us have been in this industry for over 10 years. Most of us have been in this industry 15 to 20 years. And this opportunity to really come in and kind of build the shop that we want to, we kind of spun out of SoftBank. SoftBank being a huge player in kind of the technology revolution space. Most of the technology firms, big fund firms that got some backing from SoftBank originally. And then we essentially married that technology piece with the idea of technology meets climate infrastructure. And Ares Climate Infrastructure Partners joined us last year and coming to help us build our platform. We're basically we've done about 2 gigawatts in about 3 years, and a pretty large pipeline behind that from a utility scale solar and storage perspective. So that's how we're kind of looking at it. We also invest in supply chain. So we're an investor in kind of long duration storage companies, and obviously with all the domestic content discussions, we play a role from an investment standpoint on that standpoint as well. So just a little bit of background so you know from what perspective I'm speaking from. So Jason and Lindsay talked a lot about this in terms of kind of the various players. Insurance used to be one of these things. I've been in this industry for a very long time. It used to be we had someone that was dedicated to basically someone in asset management that looked at insurance, and none of the rest of us kind of really asked many questions about it. We assumed it would increase over inflation. We'd increase it from an inflation standpoint, 3% year over year. And that was kind of offset by degradation of the facility. And so it kind of wasn't a big thing that we paid attention to. And as Lindsay shared, we're now seeing those costs increase, 10%. We've actually seen in some cases increase about 20% year over year. And now this has become a multi-million-dollar discussion. And so basically what we're having is this dance of like risk transfer. I think Lindsay and Jason really mentioned it in terms of like the spread of risk and like where is risk falling. So I'll go through, I think one is there's the three major players, right? The underwriters. I should have put underwriters to the brokers. We as the sponsor and developer, we interact with our brokers who interact with the specialty houses and the underwriters on one side of the equation. And then on the other side of the equation is our financing parties, right? Our tax equity investors, our lenders. And then they typically have an insurance consultant who basically represents to them that, yes, you have industry market standards in terms of what you're receiving. So there's a lot of players kind of in the mix of the game. And then even within our shop, right, as I was kind of saying, insurance used to kind of reside. There was someone who kind of handled insurance in asset management. Now in this new kind of new world order around this is basically everyone in the company is touching insurance. We are making decisions from the time before we're even signing site leases, and we'll talk about that a little bit later. We're thinking about it in terms of like our engineering designs. We're thinking about it in terms of our construction and operations protocols. We're thinking about it in terms of how we're engaging, which financing parties we're going to actually work with. And so this has become a really holistic piece. But I think the biggest piece here to discuss is just this, not to belabor the point, but the spread of risk that both Jason and Lindsay spoke to, which is underwriters now are realizing that they've had some significant losses, both in the thermal side and renewable energy side from a natural catastrophe perspective. And so where we used to see full coverages, we're now seeing that they'll only do, I think as Jason referenced, like $25 million in Texas ERCOT, $25 million on a $300 million project, right? That's a pretty big difference. And in addition to that, not only is it lower coverages, we're also seeing premiums increase. And then on the other side of the equation, we have our financing parties. And our financing parties, understandably, want to be as covered as possible. They're used to having full replacement costs. And so as they're seeing coverages drop, they're becoming increasingly concerned and essentially asking for more. And what I think is really interesting in this equation is that basically kind of the decision makers really are the underwriters in terms of how much they're willing to provide and at what cost, and the financing parties in terms of what they're willing to accept. But you have essentially all of these other players in the middle, particularly the developer, who are essentially having to solve for this equation. So the three big questions, I think, is how exposed is your project? How much coverage can you get, and how much is it going to cost? And so that's where essentially now, before we can actually go, given timing, before we're even acquiring a site now, we're doing something called a probable maximum loss assessment, high-level probable maximum loss assessment, and a nat cat analysis to really understand in terms of like, if we're developing in California, do we have flood exposure or fire risk? In ERCOT, are we seeing, high hail risks where in some cases we're seeing things that cannot even be underwritten anymore. There's not enough insurance, or hurricane in the south. And so really having to do that before you start investing money into these projects, really understanding what your exposure is. We're essentially designing the project, right? If we're having flood zones available, really thinking about the way that we're doing kind of our scouring techniques, and from an engineering, it adds to the CapEx, to the capital cost of building the project. And so that plays into, you need to really understand all of those things. Insurance, we used to think about at the time we were kind of reaching financial close. Now we're having to think about it at the very beginning of the project, because if not, you could get all the way to financial close and realize that actually your project doesn't pencil. And then we're also trying to think about like new technologies that we can use, right? So we have hail sensors on all of our sites in Texas. So we're collecting data early on in the development process. During construction, a picture here of, it used to be, and we've seen a couple of losses in the industry, $80 million worth of losses on one project, I think, where during construction before it was energized, essentially, the modules were all laying kind of flat, and they had a huge hailstorm come through and basically wiped out almost all of the panels, right? So, working with our EPC partners to really integrate some of those practices throughout the process. And so just to wrap it up, I think the biggest differences that are happening now is that we have to have conversations early. We need to understand the exposure of our projects from a natural catastrophe perspective very early on, to understand kind of rough insurance costs, because we can't just assume high level metrics of, $4 or $5 a kilowatt anymore like we used to. And we also need to be bringing underwriters and financing parties together to have some of these conversations early, like putting into the term sheets, understanding what our financing parties are expecting in terms of coverage, because if it's not realistic in terms of their expectations, then it may be better for us to take, a different tax equity partner on, because they have more realistic expectations of what's out there. I think just further diversification in terms of the technologies that we're using for detecting, preventing, and assessing the issues we're having, strong redundant protocols and systems. I think we're going to see a lot, and this is still TBD, of moving away from this idea of like everything being at the project level, right? That you have all of your coverages at the project level. It becomes so burdensome in terms of the cost. You have multi-million dollars being added up to meet each of the financing requirements. And so I think there's going to be more done at the corporate level as we go forward. And really, it's just education. This is all happening really real time and really recently. And so there's a lot of conversations we all need to be having together. And this is why it was so great to bring kind of 3 different parties together for this webinar. So I'll pause there.
Great. Well, thank you, Jamie. I'm glad we got you back. That was a great presentation. That's all we had scheduled for today. I think Franny had a few final comments. Hope to see many of you in San Diego at the conference, but let me invite Franny back, because I think if you stay around, there's
yes, that's right.
So.
Thank you so much, Jason, for your excellent guidance in the past hour. Thank you, Jamie and Lindsay, for your sharing your insights as well. So we will continue the conversation on solar insurance at our event in San Diego in April. We would love to meet you there, and that's why we also, as a thank you for your attendance at our today's webinar, we would love to give you a 10% discount to register. So please use this code when you are going to register for our event in April. Hope to see you then. Wishing you a very good rest of the day, and see you later. Bye-bye.